Hi guys, welcome to Boom Traders. I'm TinTinTrading and today we're gonna go over the weekly overview video. It's week 25 of 2022 and we will be covering our two main risk models. Then we're gonna look at what's relevant for the current market, and at the end we're gonna finish with a summary. The whole video is gonna be about 20 minutes and is gonna look at a lot of surveys and a lot of studies that are likely to help you gonna navigate through this market. Now the risk vest model is still on negative signal, and this was issued on 22nd of November, but since May 26 we have been talking about the buy alert. Now if you remember, I have gone through this with you before, but the buy alert is basically on the intermediary conditions going from red to green. So this is not a full-on green, but we are seeing improvements, and this is a heads-up signal. The general market has moved from negative to positive, and the up and down volume markers have moved to positive. We are not seeing much of what we want to see in the net highs and net lows on the general market, so that's been stalled on negative, and the stock participation has actually improved from negative to neutral, which has given us this reading here. We are seeing a couple follow through days, and stock participation has been rather good. From then on, if we look at the more specific model, which we call the tactical trading environment, which is there to assess how well stocks are breaking out from their bases according to the methodology that we trade on, we are seeing that this has moved to green, which means that breakouts so far are working fairly well, and you can consider bumping up your exposure. Now, if you look at the Nasdaq Composite, right up here, we issued a sell signal. Now, I have taken out two readings on the American Association of Individual Investors and their bear percentage advisors from the survey that they run. Basically, the association has about 150,000 members who educate individual investors regarding stock market portfolios, financial planning, and retirement accounts. And this survey is happening on a regular basis, and it kind of measures how many of those educators are issuing bearish signals to the retail community and how many are issuing bullish signals. Now this is a great way to pick up sentiment, and as you see right here on the top, we had only about 21% of the 150,000 members issuing bear signals. Now since then we've had this big 30% correction in the Nasdaqs, and now we see that the same reading has doubled to over 43%. Now what you want to know about these surveys is that they tend to be wrong right around the turning point, meaning that as you see, a very small fraction of the advisors were bearish, we got into this big decline, and now quite a big portion of the advisors, nearly half of them, are quite bearish, and we're seeing the market moving up. From then on, we can look at the Investors Intelligence survey, whereby we look at the percent of bearish advisors. It's a similar type survey, but another one. And what we see is that the bearish advisors are reaching levels in the COVID decline, which was at that time pretty scary. So we're reaching this point here, right above 40, and that happens and coincided with the market bottom here. Are we gonna bottom here? We still do not know, but this is good to take into consideration. If we zoom out of this chart and actually look at the larger picture, historically these levels tend to prove to be where we see a bottom occurring based on the surveys. Now if we're getting into real bad recessions like we did in 2008, 2009, we would need quite a bit more reading up from there, which is around 55, nearly 60. But this is only in the case of a bad recession occurring. If we do not have the bad recession, we can expect that this is where the bottom would occur. Now, if we move over and look at the VIX, or the volatility index of the market, we are also seeing that if you're in a cyclical correction, the 30 level is where we get a short-term bottom. Now here is the 30 level, and here is the VIX on the bottom. On the top we have the Dow Jones. Now this is also a warning sign, because once we get to the 30, unless we drop fastly down, we might be getting much more volatility from then on. So the 30 level is a place where we want to see a turning point. Now most of the times we have had a bear market bounces at those levels. However, now the volatility is dropping, as you see, and the market tends to bounce at the same time, and this is exactly what we want to see. So as long as the volatility is going down and the stock proliferate, we can be participating in this market. As you see here, before that we get to the 30 level and the market moves up from there. We get to 30 level, the market moves up. Now we're moving down and the market is moving up, which is a great sign. Now, talking about this and talking about the market bottom, here are a few of the things that we look for in order to determine that we've been getting a bottoming bear market. Now, first, we want to see the extreme bearish. And as you can see, this is a tick. We are seeing this. What I love is when everyone is bearish, but the stocks are setting up, and hence we're getting a reading that retail investors do not believe that the setups are happening, but at the same time, institutions are those who are buying them and moving the price up. So this is a great environment when we're getting these extreme bearishness on the retail side of the market. We're also looking at follow-through days, and we did get another confirmation with a few follow-through days. Now, as you know, no bull market has ever existed without a follow-through day before, and we did get a follow-through day. Now, stocks are working from breakout levels, but we will need a bit more to really validate this, but so far they're on track for the time that has happened after the breakout levels. And the only last piece that we are missing is the momentum thrust markers and confirmations, and we have not seen that yet. When we do, we can get pretty comfortable that the leaders or the next level of leaders are going to behave like this crowd of runners up here, whereby they're going to emerge and push up and make their large declines. Now, as you see, the follow-through days, we did have a follow-through day right around here, but immediately that got violated with a distribution day the next day, and we moved lower. Now, we did get subsequent follow-through days afterwards, which is an excellent sign, and those subsequent follow-through days were not violated with a distribution day. Now, if you remember, if we experience a distribution day within 2 weeks of a follow-through day, this is likely gonna kill the rally with an 80% chance. Since then, we have had this kind of quiet action on the side, and a pullback for a day or two would be normal. But what's important is that we keep on this level, this bottoming level. We need to make sure that the market doesn't violate it. So it's here, and if we do not violate it, we are looking at potential move to the upside. Now, if we look on the S&P 500s, we also see, based on the moving averages, which are pointing downwards, that we are in a downtrend. Now, this means that we would be having this overhead supply in front of us when we start moving up, if we do. And if we start moving up to here, we would have this overhead supply. Now, what's likely going to happen is, if we move up here, we would either stall out or reject and move from those levels. So this is an area where we expect the market to either pause or pull back from. If we get up to there, this is where we can start putting targets on. So we need to be conscious about these moves up there. If you have seen this study from Ned Davis, of course, we look at the history of bear markets as per the down industrial average, and I have shown you this chart before, but particularly we want to look at the non-recessionary period. So this is this green zone up here, and we're looking at that because we're not in a recession now. The green line shows where the mean is for depth and length. So what we see that this current market, the 2022 market, we are shallow and short. Now, some people say that there is a lot more to go. However, that's not really the case. There is not much more to the downside. As you can see, there's about a few 5% or so. But what we might see is that we might go much longer sideways in order to reach this mean. But that does not mean it's gonna happen. It could just stay here and move back. It's just something that we ought to consider. Now, of course, the big question is, are we in a recession or not? And here are a few examples that you might wanna go check and look on your charts. So the 1962 decline, we had a 28% decline with about 6.5 month correction in length. The 87 crash, we had about 35% decline very fast for 3.5 month correction, and the 1998 decline, we had about 28% decline with about 5 month length in correction. What's combining about all those things is that none were associated with recession, and of course they were short-lived. And exactly, if we're gonna move up here and if we're gonna continue our bull run, this is what we are looking to see. We're looking for this to be short correction before a continuing bull run. We do not know if this is happening, and the big question is, are we going into recession or not? Now here is a visualization of the 1998 cyclical bear market. This is the one that we're talking about here, and as you see, we move down about 28%. If we resemble this kind of market, we're looking to be right around here before this lockup rally all the way to the right. Now this is a big if, and it comes with if inflation is gonna come down and the market discounts that future growth. Now what's important is if inflation comes down and the market discounts that future growth, then this would happen. I personally am not expecting exactly something like this so far up. I expect to get similar move up, but with more of either a pullback or at least some stalling action here before we move up. So a bit more sideways before we move up. Even if we get, this is not very easy to trade, just as a caution. And the reason for this is that many, especially newer traders, are going to be looking at the market, which is moving straight up here. And it will be difficult to trade since they will be waiting for some pullbacks which are never going to come, and therefore you just have to bend with the market. So that's the idea. This is not very easy to trade. If we get more sideways action, it might be a bit easier to trade. So we'll just be looking at the action, and if we start getting this kind of thing, we'll want to be aware. And we keep on hitting the point about recession versus non-recession. This chart from Ned Davis shows it very well. Basically, if we look at the point where we get drawdown of about 18% in this case, so we did achieve that in the S&P 500. On the x-axis we have time and how the stock market has participated. If we are not in recession, this tends to activate some sort of a lockup rally. This is the black line here. However, if we are in a recession, then we're likely to see these rallies up, which are likely going to be faded, and we're going to see more continuation and sideways act. Now, of course, all of this comes to my favorite chart that we have been showing you for a couple of months so far, and this is the speed of the rate hikes. The market is really moving based on the Fed tightening cycle and inflation. Now, inflation is going to drive the Fed, and the Fed is going to drive the market. And the market is either going to discount the Fed's action or not. You might not wait for the market to see lower rates, and many times the market rallies prior to the lowering rates decision, and it discounts that lowering rate about 3 to 6 months in advance. So we might be getting that. But what we're seeing here is that if we continue with the fast tightening and the kind of hawkish Fed action, the stock markets after the first rate hike, which we have already seen, is likely going to move down to the sideway. If inflation comes down and the Fed becomes more accommodative, then we can see this slow tightening, and the black line is what we might experience. So far, we know that we're in a fast tightening cycle and inflation is the problem. Now, if we look at the inflation itself, if we are getting a peak here, we see this small move down, then this will turn out to be a great buying opportunity. But so far, we're reaching the 8.5. On a six-month smoothing is about 7.3. As we said, inflation drives the Fed and the Fed drives the market. Now, this week was the beginning of the quantitative tightening, where the Fed announced that they're going to be discounting about $95 billion per month in bond holdings, and we are starting to see signs that inflation is peaking, yet this is not confirmed. We need to see real hard evidence for that to happen. The peak in inflation is going to be creating the odds that the Fed short-lived this quantitative tightening, and this is what we want to see. So we want to see peak in inflation, we want to see more accommodative Fed actions. Now, talking about real evidence, Fed Chairman Powell did say that He's looking for clear and convincing evidence that we are moving to the Fed target rate of 2 before moving and stopping hikes. The Fed members also said that they're committed to rising rates and very concerned about rising prices. So, given all this information with the Fed's actions and with the Fed statements, if the market acts well while knowing all of this information, that the Fed is likely to increase rates, this is a great sign. Why? Because it shows that it's already starting to discount these future rate hikes, and this is very positive. Now, we might not see this, but if we do, we want to be aware of it. Now, from then on, if we move to the Treasury yield, you can see that after coming out of this consolidation period, we did reach 3.12 peak, and from then we're coming back. And as you see, this is completely inversely related to the action on the market. This is the S&P 500 on the bottom. We're very cautious about this level of 2.96, and if we move higher from here, then this would create more upward pressure on the market. But if we keep on moving down, it's likely gonna clear the sky from the market to move up. So in summary, we did move the risk vest to buy alert. This is the intermediary steps before a green light. The tactical trading environment is also green. Our signals are improving. So there is an opportunity here for short-term traders like ourselves. We did get a bunch of follow-through day markets without an immediate distribution. Volatility seems to be decreasing and stocks are setting up. We are getting traction on our open position and confirmation. Now, what's really important here before putting the pedal to the metal is that you have to be prepared for an instant failure. We're still not out of the woods, but things show that they might be starting to work out. This is a tradable rally, but you have to be conservative. This can happen by taking shorter term profits or moving stops to break even faster and keeping it light. In a nutshell, this is the playbook. I hope you enjoyed it and see you in the Discord room.